Welcome back. Let's get a corporate conversation going now. Latent View Analytics is in focus. They reported their Q1 numbers a few days back. It's a good start to the year, a 21% year-on-year revenue growth, and profits too have gone up 18%. Margins, though, under pressure on account of wage hikes. We have with us Rajan Sethuraman, Chief Executive Officer of Latent View Analytics, on the show now. Morning. Thank you very much for joining in. It's good, 21% on a year-on-year basis. But I remember the previous conversation where you had indicated that, maybe we'll try pushing for a 6 to 7% quarter-on-quarter revenue growth. Compared to that, this quarter you've done about a 4.5% Q1Q revenue growth. So has this quarter growth fallen short of your expectations? And if yes, what led to this shortfall?
Yeah, good morning, Reema. Yeah, you are right. It is definitely short of our expectations. We were expecting it to be in the 6.5% range. The key reason is one, the larger initiatives are taking longer to close. We had a few deal closures, but they ended up closing in the early to mid-June timeframe rather than at the beginning of the quarter. So that had a bit of an impact. And then there are some opportunities that are getting delayed as well, or people choose to do a pilot first before they launch a bigger opportunity. So all these things are playing out. The outlook is still fairly positive for the year in terms of what our original guidance was. We are fairly close to that. But yeah, slower start than anticipated.
So next quarter, because some of these large initiatives have closed in June, do you think next quarter you can push for a 6 to 7% kind of revenue growth?
That's what we are looking at this time. And it looks more promising definitely than the first quarter.
Okay, so Q2 should be better than Q1, and again, you will try for the 6 to 7% kind of revenue growth. What about for the full year? You've given a guidance of 16 to 18%, but that doesn't include the Decision Point acquisition that you all concluded. So what will the overall growth look like, including the acquisition?
So Decision Point did about 12.8 million last year. We will get the benefit of the consolidation only for 3 quarters. But we are expecting them again to do about 14 million or so, 14.5 million, right, in terms of total. We will have to look at the exact numbers in terms of, we are actually looking into the details of their first quarter at this point in time, right, and where the second quarter will end. So I'll give a better view maybe closer to the end of this quarter. But overall, including the inorganic, I think we should be closer to the 25% plus kind of a number.
25% plus top line growth for this year, right? That's what you're referring to, which is fantastic, sir. I mean, given the rumblings that we are hearing of now with a lot of talk about the US economy slowing down, recession, question marks being raised. Is that a concern at all? Because at 25%, I mean, that doesn't seem to be factored in. So what is it that you're hearing and seeing?
Yeah, so the last 2 days, obviously, things, everybody has been caught by surprise. So we haven't fully factored in if that is going to have a big impact. In general, I mean, a lot of the opportunities that we have been pursuing and even what Decision Point has been, they all are fairly close to fruition, right, in terms of the actual closure happening and revenue starting to come in. We are seeing some tentativeness in general, right, but that has been the case for the last 12 to 18 months. Whether the last 2 days will have a big impact, it remains to be seen. But taking that out of the equation, right, we were really looking at a 16 to 18% for organic and a 25% plus, right, in terms of inorganic growth.
And good you clarified that your guidance is based on a lot of deals that are close to fruition. So, I mean, therefore, those numbers are not sort of long drawn-out conversations. So, got that point. Just a word on margins as well. You're at around 21.5% now at the start of Q1. You're saying 23% is possible by the third quarter. Just take us through the levers here. I mean, is there any sort of a pricing lift in this? Or, I mean, so how do you get back to 23, and will that be a sustainable run rate then going forward?
Yeah, not too much of a pricing lever. There will be the pricing adjustments that we will shoot for as part of renewals and so on. The real impact will come on account of leverage, operating leverage. Like we have said earlier, most of the investments that we wanted to make, whether it is on marketing or capability building or the front end, that's all done. There will be a little bit of adjustment that we might do from one area to another, but we're not expecting to add significantly in terms of the percentage of revenue, right, getting invested right on the front end and so on. So therefore, as the revenue growth comes in, the margin lift will happen automatically. Most of it will fall through to the margin. And we are expecting the 6-7% kind of number, right, quarter on quarter. So that's what will help us move the overall margin, right, for the year closer to the 23.5%.
Okay. 23-25% by the end of the year is the exit margin, right?
23.5. Yeah.
23 to 23.5. Okay. Your Gen AI pipeline is about $4 million, you've indicated. How much of that could get converted into revenues? Can Gen AI contribute to your revenues in the current year? Or for FY26, do you have any estimates? And a quick word, because you've specifically called out retail as a sector where there are headwinds. What is happening on that front with your clients?
Yeah, Gen AI, we already have about $1 million of revenue in the bag, which we are executing against. The $4 million worth of opportunities in the pipeline, they are also looking very promising. In general, there is a great deal of excitement. I would say that about 20% of the conversations that we are having today has Gen AI in the mix, either as a core Gen AI kind of a project or Gen AI being leveraged, right, to democratize decision making or making the information available right in the hands of the people. So I'm fairly optimistic that a lot of that pipeline will get converted right as part of revenue for this year itself. On the retail front, yeah, in general, it has been a fairly difficult place for quite some time now. This coupled with the fact that many of the larger retailers, right, the top 4 or 5 retailers, they're all going the GCC route and they are bringing a lot of stuff in-house. So in general, there has been a slowdown, right, on account of that. Our focus is now more on some of the tier 2 retailers and some of the media-based retailers, for example. Right? So we are looking at opportunities there because that's where, again, you can make use of data analytics, right, to create the kind of competitive advantage. But having said that, I would say that retail, we are more optimistic, more on the marketplaces side, which are digital in nature, as opposed to the core traditional retail itself. Now, again, based on what we are hearing in the US, that will have some kind of impact, right, for the remainder of the year as well. So it remains to be seen, right, how that pans out.
Okay. But in terms of the large retailers, you seem to be losing work to the GCCs. Thank you very much for explaining that. It's been a great conversation, but we need to get into a short break. On the other side, we'll invite the management of Unicommerce Solution. The company's IPO opens today.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.